Hi, I'm Isabella Bernabe and I am going to talk about segment reporting and decentralization. Let's first start with decentralization in organization. This refers to a form of structure where the top management delegates responsibilities and daily operations to lower subordinates. In a decentralized organization, decision-making authority is spread throughout the organization rather than being confined to a few executives. So there are advantages and disadvantages in a decentralized organization. So let's start with advantages. By giving the low-level managers the authority to make decisions regarding day-to-day operations, top management can concentrate on bigger issues such as the overall strategies of the company. Next is decision making would be faster. By removing the need for approvals, organizations would be able to respond quickly to customers and to changes in the operations. And lastly, this would increase the motivation and job satisfaction of managers. This would also act as a training for them for a higher position. By exercising their own judgment, they will develop managerial skills that will ensure the growth of an organization. Let's now move to the disadvantages. First is managers may have different goals from the entire organization. They may be too focused on their own growth rather than the growth of the whole company, which will affect their decisions. And lastly, coordination among lower level managers may not be present. That's why the centralized organizations need responsibility accounting systems. This determines the area of accountability of the managers for the outcome of their decisions. This will be useful in measuring the performance of the responsibility center. So, what is a responsibility center? It is a part of an organization who has control over and is accountable for cost, profit, or investment. So, there are three primary types of responsibility center. First one is cost center. The manager of a cost center has control over cost, but not over the use of investment funds. Examples of cost center are service departments such as accounting, finance, and manufacturing facilities. Managers are expected to minimize cost while providing the required results. They are evaluated using standard cost variance and flexible budget variance. Next is profit center. The manager of a profit center has control over cost and revenue, but not over the use of the investment funds. Example of a profit center would be selling or sales department. Profit center managers are often evaluated by comparing actual profit to targeted or budgeted profit. And lastly, investment center. Manager of an investment center has control over cost, revenue, and investment in operating assets. This would be the executives. They are evaluated using return on investment or residual income, which would be discussed later on. So now let's move on to segmented reporting. Effective decentralization would require segmented reporting. In addition to overall income statement of a company, reports are needed for individual segments of an organization. Segment is a part or activity of an organization about which managers would like cost, revenue, or profit data. Examples of segment would be the divisions of a company, product lines, sales channel, and many more. Management uses segment reporting to evaluate business segments to assess its performance. So let's move to preparation of segmented statements. Okay, here is an example of a segmented income statement from Bernabe Products Incorporated. The income statement of the entire company is divided into two segments, the clothing division and the food division. The segment margin of the clothing division is 1,150,000 and 800,000 for the food division. This shows the contribution of each segment to the overall profit of the company. This would measure the profitability of the segment and would be useful in major decisions such as dropping a segment if needed. So to get the segment margin, we have to first determine the traceable fixed expenses that would be deducted from the contribution margin. So let us differentiate traceable fixed costs from common fixed costs. Traceable fixed cost of a segment is a fixed cost that is incurred because of the existence of the segment. If the segment were eliminated, the fixed cost would disappear. While common fixed cost is a fixed cost that supports operations of more than one segment but not traceable to any segment. This means that there are two or more segments who benefits from that cost. Even if you drop a segment, that cost won't change. But there are times wherein traceable cost can become common cost. So let's go back to our example. These divisions can still be divided into segments. For example, the clothing division can be divided into two product lines, the menswear and the womenswear. We can see that only 1,100,000 of the traceable fixed expenses on their clothing division is traceable to the product lines, while 400,000 is considered as common fixed expense. An example for this expense is the salary of the clothing division's manager. This shouldn't be considered as traceable fixed cost because even if you remove one product line, the manager's salary would still be most likely the same. Allocation of common cost to segments would reduce the value of the segment margin, which may result in wrong decisions. This shows that proper cost assignment is needed for segmented reporting. But there are some instances wherein there are mistakes in assigning costs to segments. Here are some of the reasons why. First is omission of cost. Companies may forget to include some costs that should be part of the segment. Next is inappropriate methods for assigning traceable costs. Companies do not trace fixed costs to segments even if it is feasible to do so. Next is inappropriate methods for assigning traceable costs. Companies do not trace fixed expenses to segments even if it is feasible to do so. And lastly, assigning non-traceable costs to segments. As mentioned, there are costs that are common to two or more segments. This shouldn't be assigned to one segment only and should be considered as a common cost. So I talked about the importance and how to assign costs to segments. Now let's talk about evaluating investment center performance. There are two methods in evaluating investment center performance. The first method is ROI or the return on investment. The formula to get the ROI is net operating income divided by the average operating assets. Net operating income is the income before interest and taxes, or also known as EBIT or earnings before interest and taxes. Average operating assets include cash, accounts receivable, inventory, and other assets held for operating purposes. Further understand ROI, here is another formula. Return on investment is equal to margin multiplied by turnover, where margin is net operating income divided by sales, and turnover is sales divided by average operating assets. By looking at the formula, it is still the same, but this provides more insights for the manager because margin is improved by increasing sales or reducing the operating assets, while turnover shows the effect of the investment in the operating assets. The second method is residual income. It is the amount of operating profit that exceeds the company's required rate of return. The formula to get the residual income is net operating income minus average operating assets multiplied by the minimum required rate of return. So to better understand the two methods, let us try to answer this problem. The clothing division of Bernabe Products Incorporated has reported the following results for last year's operation. So we can see the two product lines on their clothing division. So for requirement number one, for each segment, compute the return on investment. In computing the ROI, we can just divide net operating income divided by average operating assets. But let's try to use margin and turnover. To get margin, we have to divide the net operating income by sales, and the turnover is sales divided by average operating asset. Now we have 23% ROI for menswear and 21% ROI for women's wear. Requirement number 2. Assume that the minimum required rate of return for any segment is 15%. Compute for the residual income for each product line. So to get the residual income, we have to first get the minimum required return to be deducted from the net operating income. So let's get the average operating assets, then it should be multiplied by the minimum required rate of return, which is 15%. Now we have the minimum required return. Then let's deduct the net operating income by the minimum required return. Now we have the residual income for both menswear and womenswear. 150,000 residual income for menswear and 312,500 residual income for womenswear. Requirement number 3, compare the answers in 1 and 2. So here we can see the summary. Based on ROI, menswear division is higher compared to women's wear. By using this method, we can say that menswear is performing better because the higher the segment's ROI, the greater profit earned per peso invested on the segment. But by looking on the residual income, women's wear division is doing better because its residual income is 3 times higher compared to the menswear. We can say that the reason for this is that women's wear division is a bigger division compared to menswear. Requirement number 4. Suppose that the manager of the menswear segment is considering purchasing a machine that is expected to generate additional operating income of 180,000. The machine would cost 1 million and the minimum required rate of return is 15%. First scenario is if performance is being measured using ROI, would the manager continue with the investment? So let's compute using return on investment. So we will just repeat the process, but we have to include the effect of the investment. So the current net operating income is 450,000 plus additional of 180,000 and average operating assets of 2 million plus additional of 1 million from the investment. So now we have the ROI. So if ROI will be used to measure the performance, the manager would not continue with the investment because it will decrease the return on investment of the product line. From 23%, it will go down to 21%. For the second scenario, if performance is being measured using residual income, would the manager continue with the investment? So let's compute using residual income. Current net operating income is 450,000 plus additional of 180,000 from the investment, the minimum required return, which is average operating assets multiplied by the minimum required rate of return, which is 15%. So for investment, it's 1 million times 15%. So now we have the residual income. If residual income will be used, the manager would continue with the investment because it will increase the residual income by 30,000. Here we can see that the decision will depend on the method used for evaluating the effect of the investment. Managers who are evaluated using the residual income will pursue any project whose rate of return is above the minimum, while managers who are evaluated using the return on investment will reject any project whose rate of return is below the division's current ROI, even if that rate is higher than the minimum. So just like this one, 18% is higher than the required rate of return of the company, which is 15%. But the manager would still decline because it would decrease the ROI of the segment to only 21% rather than having it at 23%. So that's all for segment reporting and decentralization. Thank you for listening.